Hello, this is Ricky Walters, certified mortgage advisor with Landmark Lending and the Mortgage Wise Guy. Today's topic that we're discussing is what drives mortgage rates on a daily basis. Is it the Federal Reserve? Is it the 10-year Treasury yield and the mortgage-backed security market, or is it inflation? Well, if you said A, the Federal Reserve, that is the least correct, and that's often what people think because they hear what the media says and gives a false impression. If you said inflation, that's pretty correct. It's not the most correct, but it does set the trend of where interest rates are going. The actual most correct answer for mortgage rates on a daily basis given by lenders to consumers is the 10-year Treasury yield and the mortgage-backed security market. This graph shows that over time, historically, that basically inflation and interest rates move in tandem over time. Not exactly every day, not precisely, but pretty much in tandem over time. The question is, when will inflation peak to keep bringing interest rates lower? And I say keep bringing interest rates lower because really inflation has already peaked. In fact, we saw on November 10th, which was the October report, we were replacing a very high month-over-month core CPI inflation report with a much lower number. It was the biggest rally in bonds and mortgage-backed securities of the year. So what else is going into this that's possibly affecting what's going on with inflation? Well, the shelter costs in this core CPI makes up 39% of it, so almost 40%. And you can see we have a big bubble here. And even though we're seeing shelter costs on the decline in the present day, it looks like the way it's measured in this report, because they measure this whole big bubble for the last year, it looks like it's actually going up when it's coming down. It's kind of like if you've ever been on a roller coaster, the real shelter costs are coming down at the front of the roller coaster. But we're looking at a snapshot in January, and the shelter component of it is still going up. So it's kind of a drag on the decline of real core CPI. This last graph is kind of a two-layered. It shows at the top the core CPI, and at the bottom it shows the shelter component in the core CPI. So we've seen, as I mentioned before, a lot of progress from these high month-over-month numbers being replaced with low month-over-month numbers the last 3 months. But unfortunately, we're going into the January report, which comes out on Valentine's Day, February 14th, and that's a very low comparison from last year when we're seeing the costs still go up. So we're expecting that to be a little bit of a headwind. But wait a minute, wait till we get to May 10th. Circle May 10th on your calendar. Why? Because we're going to replace a high core CPI number with a much lower projected number as inflation is coming down. And also the shelter cost, that component of it, a high number, should be replaced by a much lower number. So what does this mean to you if you're in the market to buy a house? What it means to you is buy now, don't wait. Why shouldn't you wait? Because if you wait, there's going to be a whole lot more people who see interest rates come down, and you're going to have a lot more competition, and the cost to buy the house, you're going to have to bid higher, especially you live in the Bay Area. So what I always like to say is divorce your landlord, marry the home, that's your long-term relationship, and date the rate. You can get a much better deal right now, buy the house that you want, and refinance it 6 months from now as rates go lower. This is Ricky Walters, the Mortgage Wise Guy. Thank you for watching.